gas lines in Beijing, markets, and a big IPO. Gas lines appeared in Shanghai and Beijing for the first time in 2 years, finally capturing the attention of China's national politicians. Angry lines of truck drivers got vocal and in one reported incident violent about the shortages and rationing of fuel over coastal and, starting this week, interior regions of China. The disruption was spiking inflation in Shanghai and causing embarrassment in the lead up to next summer's Olympics in Beijing. On Wednesday, Chinese refiners were allowed by China's top leaders to raise prices for refined oil products 10% overnight. China's oil shock was not due to any embargo or disaster to the oil industry, but to a deliberate shortage created by the big Chinese refiners, the holding companies for Chinese oil retailers Sinopec and PetroChina, whose stock is owned by people around the world, but still largely controlled by the Chinese Communist Party. PetroChina, in fact, is poised to overtake ExxonMobil soon as the world's biggest corporation. The day before the National Development and Reform Commission, an agency of China's State Council, gave the green light for the price increase, a Sinopec executive told the Reuters news group that it was closing down a major refinery, an action that would create a national shortage. Even with the price rise, vehicle fuel in China is still less than the current average per gallon cost in the United States and far less than the price per liter in Europe. The reason Chinese refiners slowed output was to stem losses from the new rise in crude oil, now hovering under $100 a barrel. They cannot pass on fuel costs to consumers because of government price controls, and so will again be subsidized by a cash infusion from Beijing. Only 2 years ago, the National Development and Reform Commission warned that China's refining capacity was insufficient. There are several huge oil refinery projects planned in China, but they are years away from production. Ironically, only 10 years ago, China had excess refining capacity as the oil and gas industry was spread around the country, with many locally owned small capacity refineries, a legacy of the Mao era. But those small and fragmented companies were forced out of business or sold off to create the big Chinese energy conglomerates. They are now aggressively consolidating and exerting new influence on the government. After a steady rise all week, the Shanghai Composite Index dropped down to settle just above 5,777 at the Friday close. As I've mentioned before, the index appears reluctant to stray far from 5,500. The CSI 300 index, still the world's star champ for the year, dropped over 2.33% November 2nd to close at 5,472.93. Like the Shanghai Composite, it seems mesmerized by the 5,500 line. After a big plunge at the end of last week, Shanghai Bs recovered somewhat, but are back down today to close at 370.408. Shenzhen Bs recovered nicely from last week's slide, but ended November 2nd at 784.174. The Hang Seng Index remains above 30,000 and closed today 30,468.34. There are now about 8 weeks left to 2007, and it seems almost everyone with an opinion on Chinese and Asian markets is blowing bubbles. Once again, no longer questioning whether asset prices, particularly stocks, but also property and to a lesser extent commodities, are investment bubbles, but when the bubbles will burst. I have a couple of general observations. First, observers continue to press the comparison to Japan in the 1980s, the Nikkei bull run, and NASDAQ during the dot-com days. As I crudely showed earlier this year, comparing support and resistance charts from those bubbles to today's Shanghai Composite and Hang Seng does reveal interesting similarities, but the reality is incredibly different. For example, as high and unrealistic as some price-to-earnings ratios appear right now with some Shanghai stocks, they are still far less than the zany PE levels of NASDAQ in the late 90s. Compared to Japanese equities in the Nikkei run, Chinese companies' earnings are strong and steady and growing. When it comes to property assets, the real estate values in China are nowhere near the valuations seen in 80s Japan or Hong Kong before the Asian currency crisis 10 years ago. The pace of urbanization in China and the ancient Chinese reverence for property make the potential for a bust in Chinese property remote in my view. As for equities, will the bubble burst? I've got a balloon and pen ready for the occasion, but when it happens is anyone's guess. I predicted the Shanghai Composite would be at 4,600 around the start of New Year. Will it lose 1,000 points between now and then? Let's see. Biggest story of the week and next is the A-share IPO of PetroChina on the Shanghai Securities Exchange. Were the 2 and 3% or more drops in the indexes this week because anxious investors are readying their cash for the new shares? Trading begins Monday, and everyone expects the offer to raise up to $10 billion US. I'll be back with more next time. See you then.